I'm going to look at a simplified portfolio that's only going to contain 2 assets. However, you can use this formula on a portfolio that contains as many assets as you'd like. So we have the expected return of asset A. So let's write expected return of asset A. And we're also going to have the expected return of asset B. There's multiple ways you can calculate this. However, I've got other videos that cover that. You can sometimes take averages over periods of years. You can look at dividends payouts versus what the current stock price is. I've got other videos, but in this example, we're going to make some assumptions. We're going to now use this to represent the proportion which is the weight of the portfolio that's invested in asset A. So it's rated between 0 and 1. So let's say you put in 40% of your money into this and 60% into that. It will be 0.4 and 0.6. And then, so obviously 1 minus, I'm going to call this one reverse fish, is going to be the proportion invested, this is asset A in asset B. Generally, this is called weight. So whatever is weighted on A and weighted on B. So we can now formulate some sort of equation from this. So we want to know what the expected return is, which is going to be reverse fish E RA plus 1 minus reverse fish ERB. So let's slap in a little example. Let's say that the return for this is going to be 10%. For B, it's going to be 6%. And 70% of your money, so let's say 70% of money is put into A. So it's put into this one. That means you know that this is 0.7 and 1 minus this is 0.3. So now we have everything we need to use this formula. So if we now start plugging in, we're going to get ERP, which is going to be 0.7, which is there, dot ERA, which is there, which is 10%, but we would convert that into 0.1, plus 1 minus that, which is 0.3, and that's going to be multiplied by 6%, which is 0.06. So if we now simplify this all out completely, it's going to be 8.8%. So the expected return on the entire portfolio is 8.8%. However, this formula does not factor in for risk or the standard deviation of the return. So this is the most basic way to calculate an expected return. I am now going to be doing more videos, and there's going to be more videos that you can watch that will show more complex ways that you can calculate the expected return.